All right. So we talked about break even and its importance in helping us plan appropriately, forecast appropriately, evaluate if our pricing is okay, if we are profitable. Yeah, all that we were able to review that, and I showed you from a single product to multiple product how you can be able to determine your break-even point. And you'll notice I didn't mention much on unit economics, but you'll notice in all in all, we are trying to bring out the aspect of unit economics. It's very important when you are pitching to bring out the unit economics based on the business. Okay, for example, if you've spent say $100,000 in advertising, marketing, and sales, and you received maybe 1,000 sales, so that means your cost of customer acquisition is $100. Okay, so understanding what is your cost of getting a customer is important. And these are things that when you have insights, people appreciate that you understand your business more. You are separated from a typical business person. Price, if you are producing a product, what is the cost of making or producing each unit? What is the cost of selling? Okay, what is the cost, or what is the general cost per unit? Okay, what profit, based on the price that you sell, what is your profit per unit, profit margin per unit? And every time you sell, what is your profit per unit? These are simple things, but they really bring out competence in the entrepreneur. And what is the importance of unit economics? It helps us forecast profits. So when you mention this, an investor can easily understand, okay, this is their profitability, these are their margins. Okay, then it can also help you. Sometimes your cost of production is high because probably you are not producing efficiently, or the machines are not efficient enough. Now there, that can justify, and you can say, you know what, my current cost, or my current cost of production is $100 because one, my machine's efficiency is low, and I currently cannot maximize the production potential of the opportunity that I have. That's why I need an additional machine which will produce maybe 400 kilos per hour, and that will allow us to increase our production, reduce our cost, and our cost will shift from $100 to $20, and our margins will increase by 80%. Now look at that thought process. Okay, that is really about unit economics. So I would really encourage us to look and articulate our businesses that way. Tomorrow we shall be looking about pitching, especially some of those critical things, and we cannot escape from unit economics. We don't want you to pitch just the way anybody pitches. We want you to pitch based on a deep insight understanding of your business. All right, we looked at the income statement and the items, balance sheet. The assumption is you at least have basic information on some of the three statements. So I'll not delve so much. I'll practically work on a statement today. Okay. Yeah. So we looked at income statement. Basically, it's revenue minus expenses in general. Balance sheet is assets is equals to liabilities plus stakeholders' equity, and cash flow is really the change in cash. Now, today we are going to now practically do it. Let me see. We're going to practically work on a document, and I've shared with you a template, and I'm gonna start by opening that template. You can follow what I do, or you can do what I do. Either way, you will still also have a video to practice, and I hope you will pay attention. I'm going to try and be a little faster, but the first part of today, I'll link the three statements. Let me just go back to this slide. I'll try to link the three statements, income statement, balance sheet, and cash flow. I'm going to sort of work on the three statements and link them. That's what we are going to do first. Then on the second part, we shall have maybe a break discuss a bit, then do valuation analysis, and basically that will mark the close of today. So it's going to be a bit heavy, but I hope we are ready to absorb, or at least ready to take notes. Okay, so I'm going to share my screen. So for those who have the document, I'm going to work with the template called Financial Analysis Templates. That's the document I'm going to work on. Let me just get it. Let me stop sharing first and then share the document. And the assumption I'm making is, since all of you, actually from yesterday, most of you said you have numbers, you have your numbers. So that makes it a bit easy for us to see how to approach it. So let me open the document. I didn't have it open. Okay, let me open it first. Okay. So what we are covering is part of what we call corporate financing. So it's a bit, you'll find not all accountants handle it, because this is on the corporate finance area, because it's about decision making and planning. Accounting is day to day, but it really counts on what is operationally captured from the accounting perspective on our day-to-day activities, and it feeds into what we can do with corporate financing. So you'll realize it's highly dependent on the details that you have as an organization. Okay, so I've opened the document. Let me just, all right. Okay, let me share my screen. Okay, there's my screen. You can see the cover page here, just as I had explained yesterday. Usually this financial analysis, sometimes you always hear investors can ask, or financials can ask, send me your financials. When you say send me your financials, ideally it can be packaged this way, so I can say, what's the name of my company? I'll say, You Are Great Enterprises. You Are Great Enterprises. Financial model, I'll put the email. You are great. Great.com. I hope you're all following. Phone number, I'll put a phone number, 256. I do 256 because if the assumption is you may be dealing with a local and international investor, so having the international code makes more sense to me. Website, if you have a website, you can say You Are Great. You Are Great. Okay. So that gives them an insight. And by the way, sometimes there are financials who don't care about your business plan. They just want to see this and it informs them. Okay, if you want to change if you have another picture, you can replace it when you just go to insert. You can go to insert pictures. Let me see if I have any other pictures here. Yeah. Well, I'm not going to change the map of Uganda, so let me just leave it at that. So I can say I deal with electronics, solar products, and probably can installation and maintenance, and just leave this. Okay, and then I can as well, these are simple things. I can make it have a color. Yeah, so you can see that tab looks really nice and good. For those ones who are dealing with break-even point, I can have products here, and this table that you are seeing, I hope you can all see this table. This table will be able to help you. You don't need to know the formula or whatever. All you need to do is, if you are dealing with a single product, that means the other products are at 0, okay? Are at 0. And yeah, it will be at 0, okay? So that means basically your price will be that. And wow, I didn't put, well, depending on, well, this one was just to help people who have several products to align. So I'll leave it at that, depending on the products that you are doing, so that you don't find your numbers struggling, or you do not struggle with your numbers. 45K, let's do 25K. So for example, if I am looking for, say, 100 million, so I'll say the fixed. I'm looking for 100 million, so I'm putting at 100 million. 100 million, 1, 2, 3, 4, 5, 6. I hope. Yes, that's 100 million. Okay, I'll put that 100 million, and then break even. Break even units. You can assume it can be kilos or liters depending on what they do. That break even will be equals to this divided by price minus the variable cost, and that will give you that. Okay, so that gives you 8,242. So if you want to know how many of product A you need to do, that will be equals to this. It will be equals to this times the percentage of contribution of product A, and that will give you, for product A, you need to have this number of units to break even. For product B, I'm just recapping yesterday because today I'm going to do the financial model. For product B, I'll just take the same. Sorry, it will be equal to this. The break-even times the contribution of that product B, okay? And that means for product B, I need to produce 2,839 units. And then for product C, I'll do the same. I'll take the number of units multiplied by the contribution, and that will give me 3,000. And you'll find, obviously, it will total up to what we got as our break-even point. As you can see. So hooray, 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 hooray. Okay, so that's basically about break-even. So that can help you know of which products do you need to break even, if it is product A, product B. So that allows you to optimize your cost and resources. Okay, that was on break-even aspect. All right, we're going to financials too. And that is what I shared. Okay, I can as well change the color. I'm just taking you through some of this so that you can make your work also look nice. As you can see, that color has changed. All right, so we are good to go. So the assumption I am making now, and what we are going to do now, is we are going to do financial forecasting based on our past to look at the future, okay? And yeah, that is what we are going to do. So you can just follow keenly, and we proceed. All right, so let's proceed. I'll start with the first and most important thing. Remember, in the past, let me just guide, and that was in accordance to yesterday's session. I told you if you have the numbers, you will feed in your revenue, okay, your cost of goods sold, and you'll get your profit, okay? Okay, so the assumption is you have your revenue of your previous years, whether it's 1, 2, or 3, that's up to you. Then that will help us generate the gross profit margin. Then, as you can see in black, you are not touching, you are just feeding. Where it is blue, you replace with your actual numbers, okay? And it will compute, okay? Same to, so here I tried to put together the operational costs. We call them selling, general, and administration. You can call them operational costs. Either way, it's fine. So you'll notice on the assumptions, I had 2 costs, but I added them together. Okay, just that's something I just want to point out for sanity of the process. Okay, so once you put your operational cost, that's the total. And when you subtract it, you get your EBITDA, earnings before interest, taxes, depreciation, and amortization. Okay, once you subtract, and I told you that EBITDA is very important, and you're going to see in the second part of today's session that using EBITDA, we can actually calculate the value of the company, okay, under the market approach. And then we shall remove the depreciation and amortization, and then have our earnings before interest and taxes, then remove our interest, and then we'll have our earnings before taxes, and then remove the corporate tax, and we get our net profit. Okay, so that is pretty much. So the assumption is you have these details. So I'm not really going to delve so much because these are based on what exists. Okay, but remember, once you feed this information up here, it is going to help us generate key assumptions. Okay, and these assumptions are what we need when we are forecasting. Okay, so because of your past, we can now be able to project the future. So when you feed your details down there in blue, it will generate the assumptions in black. Okay, and yeah, based on that, we can proceed. There are some assumptions which you may not need to, I may need to adjust here a bit. Clear on my drawings. Yeah, but in general, that is basically what it generates. So when you put your revenue, it will show how your revenue is growing over the years, how your cost of goods is related to revenue. As I said, I combined these two so that it's just one called selling, general, and administration, so that I just wanted to put the operational costs as one, general and administration, or you can call them operational costs. Administration. Either way, it's fine. Nice. Okay, so yeah, this is our beginning point, and we can say on your marks, get ready, and proceed. So we're going to forecast. Now, there are various ways you can forecast, but it has to be very logical in the thought process. And I remember in the previous slide I mentioned, are you looking at is it that you are investing costs is increasing? Okay. So depending, sorry, my network went a bit loose. Depending on what initiative you are doing, then the percentage can increase systematically or exponentially. But you have to have a justification, because here on forecasting, you are basically going to generate based on a justifiable cause. Sorry. Okay, I hope I'm audible. Sorry, there's been a bit. So I'm going to assume I'm not doing much of strategic moves in the company. So I will basically make a modest change. So I'll say I can either use average based on my past. Say I'm going to have an average of last year and the year and the previous year and simply get that 13%. Okay, I can do that. The other alternative is I can say, you know what, I think next year I'll grow by 20%. It's really up to you, but you have to have a justifiable reason. If you're doing something significant, you're expanding, then you can say, okay, based on the expansion plans, I expect my revenue to increase by 50% because, okay, so I'm going to put an assumption of either way. Okay, let me put 20%. Okay, I'm assuming I'm going to do some serious marketing, serious production. For the other years, I'm probably going to say, now since you're going to pitch first, the assumption is maybe in 2021, you're going to attract some financing. Okay, so yeah, your revenue is going to increase and maybe increase by 30% again the following year. Okay, so I'm going to expand this a bit. And then I'm going to say maybe the next year it will do 30. As I said, these are assumptions and you are free to make assumptions. The beauty about this model is I can send to somebody and he changes the assumptions and it still changes the figures. That's the beauty. And that's why I'm approaching it in a fairly fluid. It's going to be a bit fluid so we can play around with the numbers. Okay. And that's what financial models do. Okay. So 20%. The rest I'll say it's going to be constant of years. So I'll do this and just say average. As I've said, just have a justifiable 1, 2, H6. Okay. Sorry, what just happened? Okay, sorry, I'm going to repeat that again. Feel free to interrupt me just in case there's something you need to clarify as I proceed. Okay, so I'll just keep the rest as a moving average. We call that moving average if I want to continue a constant based on the past. So so the first significant move is I'll start with revenue, forecasting. And in the forecasting, I'll base on the changes. If I'm going to invest on a new initiative and whatever, then maybe I'm going to produce more. And because I'm going to produce more, then I'm going to sell more. Obviously, if I'm increasing my revenue, naturally, I have to increase my marketing spend, okay? And my production is going to increase. So will my cost of goods increase. Now, since my revenue is increasing here, I'll say, okay, in the past, my cost of goods sold has been increasing. As you can see, this is cost of goods sold as a percentage of revenue, okay? So in the past, based on the information I have input, I can say now, since this is the pattern I've been seeing in the past, I'm just going to do an average of the previous years. So here I'll just do the average here. As I said, the first and most significant thing is on the sales or revenue. Once you do that, the rest just flows systematically. So as you can see, yeah. Okay, I've finished on the cost of goods sold assumptions. On operational costs, these are fixed. So usually the assumption is you have a budget, that is salaries, my marketing budget, whatever. So here I'm just going to say my budget is going to be here at 45,000. Here I'll say it will go to 50K. It will be, and because I'm inputting here, I'm hard coding, I'll put this in blue. It's just a standard practice, but yeah, 50K. Here I'll put 55. I'll say it's just increasing by 5K.
60,000, here 65,000, here 70,000. Okay. These are fixed costs. So fixed costs, we usually, you can just simply put based on your budget. Okay, the assumption is you usually budget like in this year, I'm going to have this new staff, I'm going to have the, so it's easy to budget because you can predict. Variable costs you may not be able to predict, it's dependent on a number of things. Okay, so here I'm just going to convert this to have UGX there, and this is how you do it. Yeah, and now we've added the sign. Some people don't like it, some people like it. Either way, I'm just going to keep it this way. Okay, then I'm going to depreciation and amortization. So here, because we fed in the depreciation and amortization, I'll just maintain a moving average and say average. A moving average means if I do this average of this years, as you can see, 2018 to 2020, for the rest of the years, as I expand, it will just continue doing an average of the last 3 years. That's why I've said I've used moving average for that. Okay, so I'll just expand. I'm expanding the same formula that I've done, and it has, yeah, that's what it is. Okay, next, interest. Now, interest on debt, the assumption is here you have a loan, or you know the standard rate of a loan. Okay, so here in Uganda, usually the standard rate ranges from 18, if it's the bank, 18 to about 25 is standard. Okay, so if you know the standard rates, you can change here. Okay, so for purposes of continuity, I'm just going to do also a moving average, but I can as well change and put 21% or 20%. Okay. Okay, let me do that. Let me just do 24 for sanity. Okay, let me do percentage 20. Let me just ensure first that it's a percentage. As you can see, I'm making an assumption that we are fairly familiar with Excel. That's an assumption. Yeah. So I'll expand that and say, okay, I'm going to keep the standard rate, interest rate of loan as at 20%. Tax in Uganda, the income tax is 30%. So I'll just put the 30%. I'll maintain the 30. So I can type, or I can simply just so don't worry, but I can still type the 30%. It's still one and the same. Sorry, and I'll extrapolate that way. Okay, so we've done the tax. That one is standard. Now, as you can see, now we are at balance sheet assumptions. On balance sheet assumptions, sorry, I need to change something here. Okay, perfect. All right. On balance sheet assumptions, since based on the figures that you put, it showed that your accounts receivable, or it takes 18 days for you to be paid by your customers that you sell on credit. Okay, those are accounts receivable. Inventory days is how long it takes for you to sell a product that you have in your stock. Payable days are days it takes for you to pay your suppliers. Okay, so I'm just going to maintain this and say, okay, since it's 18, I'm just going to do a moving average. In some people, it may change from year to year, so it doesn't. So you may need to adjust that accordingly. So I'm just going to extend this. Okay, I'm going to do for inventory days, the days it takes for me to sell stock. I'll just maintain that. I can do I can type 73 as I've said, or I can do moving average. Either way, it's fine. Okay. Payable days I'll also maintain, but
You see, when you do your annual books, sometimes you can realize it takes a bit long for me to sell or for me to be paid, and you can refine strategies to ensure that people pay fast and whatever. So those days can be adjusted. Are we together? So I'm going to put moving average because for some of you, the details may be different. So I'm just gonna do this. Okay, so that's that, 37, I'll maintain 37. Okay, then we'll go to capital expenditure. Susan, you have a question, please ask.
I was asking about those spreadsheets. Are they being provided to us on our emails? Because we might have to do this on our own.
We shared. I shared. It just looks like when you come a bit later, it's like Zoom does not give you the document, or it doesn't show, because I shared on the chat. I've shared it twice. But we shall equally share with you on mail. Diana has a copy of those documents. I had shared with
thank you.
Though it was a bit late. All right. Okay. Capital expenditure. So here, remember, some of you are going to pitch and you are going to either add infrastructure, buildings, whatever, to buy a machine. So here I can say, I'm going to invest a bit on machinery or whatever. So I'll put the amount of money that I'm going to invest in assets. If you are going to invest in a software or you are going to build a software, you also indicate that cost because it's a capital expense. Okay, so I'm just going to put my capital expenses here. Put maybe here I'll do 35K. Here I'll do maybe 25K. Here maybe I'll do 10K. So some of you may be buying vehicles, motorcycles, whatever it is. You factor that on the capital expenditure. 30K. And yeah, leave it like that. Okay. Okay. Let me just make this UGX, and this is how you do it. You go there, you go to accounting, then I can change. I prefer UGX, not UG shillings. Yeah, there you go. Right. Okay. Next is debt issuance. So if I'm going to borrow money through Pitch First or whatever, then maybe I'm planning to borrow like 200K. Okay, let's say I'm going to borrow, because based on my digits, okay, I'll do 200K. Okay, let's say 500K. Okay, I'm going to borrow 500K in debt. Then what else am I going to do? Maybe I'll also get an equity partner who will give me maybe 100K. Okay. Yeah. Then this debt, I'm going to pay part of it in this year. In the next year, so I'll say maybe I'll pay 150. Then I will pay the other year 150, 50, and then I will pay, what is the balance? 100, 100, and 100. Okay. Okay, let me see. This is, then I'll be giving out some equity, more equity, 300. Okay. Yeah, the rest I can just leave it at 0. 0 and yeah, 0. Okay, so I'm also going to convert this to VGX. And yeah, go to accounting and put the currency. Okay, so as you can see, we have basically finished the assumptions, and I'm going to put this in blue just to tell, to indicate that these are fairly, these are things that are flexible. I can, yeah, sort of. Okay, so we finished on the assumptions, and this is usually
biggest logical parts when you're forecasting, because you are here, what you are declaring is for planning ahead how your business is going to be. Okay, moving forward. Now,
based on the assumptions, okay, based on the assumptions that I've created, I can easily now generate my revenue. I can easily forecast my revenue. So this I'll do.
It will be, as you can see, we say our revenue will grow by 20%. So I'm just going to pick my last revenue and multiply it by, I'll say 1 plus. Okay, because I want the full figure. Okay, so that means I'll generate 157K. Okay, so with the same formula, I'll just extrapolate or extend the formula, and that is what happens. I'm going to reduce the decimal
points to 0, and then I'm also going to, I'll add the UGX later because it looks like I need to perform most of them. For cost of goods sold, as you can see on the assumptions up here, we said cost of goods sold will be 39% of the revenue. It's a percentage of revenue. So I'll just check this is equals to this. Sorry. Oh yeah, it's okay. Times the revenue. Okay. So as you can see, it has computed very well. And I'll just extend the formula. As you can see, I'll just extend it like that. So it will just compute for the rest. Then now my gross margin, as you can see, the formula was already there. I'll just pick the formula and extend it, and it will compute for the others. So it will already tell me how my profitability is going to be in the next year. So I'm just going to add UGX to this. Counting UGX. Okay, and do that. Okay, so if we now know our gross margin in those coming years based on my projection, and I'll do that. All right, let's proceed. Selling, general, and administration, we already have the, okay, so I'll also project the gross margin percentage because the formula is already there. And as you can see, it is indicating the gross margin will grow by 61%. Okay, I'll just, leave it at that. Then now I'm going to pick the selling general. Remember, we put it in the assumption, so I'll just pick it from up. It's here. I'll pick it and pull it down and extrapolate because it will just pick for the other years the same way. Okay, so it has already picked that. All right. All right, so so I'll just also extrapolate this. It's not a cost, so I'll just leave it at that. Change this to black. Okay, so the total, this is the total of the operational costs. Now, when I do the profit minus operational costs, as you can see, that formula is already there. I'll just extrapolate here. Sorry, yeah, and it will give me my EBITDA. Don't forget that EBITDA, because when we go on valuation, it's something that we may pay attention to. Okay, now at this point, I cannot proceed because I don't know my depreciation and amortization. Okay, now I'll stop at the income statement at that juncture, and then I'll go to the balance sheet. Okay, we shall come back to this because we don't have our depreciation and we have to work on the depreciation. So I'll go to the balance sheet, and as you can see on the balance sheet, it has the accounts receivable, inventory, and remember we made some assumptions. So what are the assumptions on receivable? The assumptions on receivable, it says it's 18 days, okay? and inventory it's 73 days. Now in accounts receivable means I may have sold all that amount of money, but since I'm at the end of the year, there is still some payment I'm yet to receive because I will receive it 18 days later. Yet I'm at the end of the year. So what I'm going to do here is I will now determine what my accounts receivables are. So I'll multiply, I'll get the revenue, which we have here. The revenue is clear, okay, multiplied by the 18, okay, the duration of days it takes for me to receive the money, and I divide it by 65 because there are 365 days in a year, okay? And now that will give me what amount, what figure will it give me? It gives me 78. So I'll just remove the decimal. I don't want to work with decimals for now. Okay, you can work with decimal, that's still fine. So I'll extrapolate the same formula. Okay, so that has already brought me my receivables for the rest from the projections. Then I look at inventory. Inventory is like stock for those who have stock. So here we said that it takes about 73 days for my stock to be with me. So what I'll do is I'll take, because stock is part of cost of goods sold, it's part of the cost of goods sold. So I'll pick, it's a function of cost of goods sold. So I'll pick the cost of goods sold, which is here, multiplied by the number of days it takes for me to sell stock, because at the end of the year, I will still have some stock. 73 divided by the 365 days, okay? And here, that will give me that as a figure. I'm going to remove the decimal points and then extrapolate this. Okay. Okay. So there I have my receivables. I have my inventory details. So this is a projection of the inventory, the value of the inventory that I will be having in my stock during those forecasted years. Okay. Now there we are already working on our balance sheet. Okay. So here I can do this total. I can capture the total and say this is, I've not yet computed cash, but it's part of the calculation. So I'll just put this is equals to sum, or you can add specifically, but I like using the sum function. And just do that. I'm still going to remove the decimal points because I don't want them. And yeah, and this was already there. In fact, I don't need to repeat. I can just as well just pull this because the formula already exists. I'll just pull this, sorry. So that's fine. So it has given us the totals there. Then I'm going to go on payables. Okay, property and equipment. Property and equipment, we don't have property and equipment yet. So we are going to compute that. I'll show you. But something that we also have is payables. Okay, so we can calculate payables where we say payables is also a function of cost of goods sold, because these are people we are supposed to pay for what they have supplied us. Okay, so I'll do this is equals to the cost of goods sold. It's a function of cost of goods sold. That cost of goods sold multiplied by the days it takes for me to pay the average, yeah, divide by 365. Okay, so that comes to that. Okay, and then I will extrapolate this. Okay, I'll extrapolate the formula, and that's, now we have receivables, payables, and inventory days. Now at this point, okay, there are companies which receive money in advance. Some of you receive money in advance, then you do your work later. So for those of us who do in advance, we call that deferred revenue. They evangelize you, yeah? They evangelize your service. Yeah? So it's called deferred revenue. So it's also a liability. But I'm going to assume most of us do after the work, then or we receive work, then we pay. Okay, so we don't have property and equipment, as you can see. or assets. And remember, we also did have depreciation. Now, we are going to work down here. We have what we call supporting schedules, okay? So these supporting schedules, we're going to use these supporting schedules to compute the things that we need now to fill in all the statements. Now, one of the things we need to compute is the working capital schedule, like our working capital. How is our working capital in the business? So remember, we have computed accounts receivable up here. So I'll just go and pick the accounts receivable. Where's my account receivable? Account receivable is here. I'll just pick it, and yeah, so it will just and I'll extrapolate, so it will pull the others back. Okay, then I'll go. I have already calculated inventory. I'll go to the inventory and the balance sheet and pick it. Where is inventory? Yeah, there it is. Pick it, paste. Yeah, I'll have the inventory. I extrapolate. Then I will go. We also have our payables, so we'll also pick our payables and go up and pick where the payables are on the balance sheet. Yeah, there they are, and pick them and put them. Then I will extrapolate. Okay, now that is done.
Wow, perfect. It's now moving well. So what do I do here? I'm now going to calculate the net working capital. So net working capital, you can see the formula was already there. So it is the assets minus liabilities, the current assets. So that's accounts receivable plus inventory minus payables. As you can see this formula here. So I'll just pull the formula and extend it to the other. So it will just compute it. Okay, so there we have our net working capital. But now our cash flow usually requires the change, not the net working capital, but it wants the change. And what is the change? It is the current net working capital minus the previous net working capital. So I'll just do this is equals to this minus this. Okay. To confirm that, I can just delete this. Still, I can delete the formula and then go in this first one. As you can see, 97
in D97 minus E97, this minus this. So
since the formula is there, I'll just extend it to the others that I've already generated. Okay, so it will give me the change in. Now, this is a very important factor because it's these numbers, I'm going to use them in the cash flow. Okay, so we've worked on the working capital schedule and finished. Then we go to the depreciation schedule. So what is the depreciation or the property and equipment or the fixed asset schedule? Some people call it, there are several names: depreciation schedule, fixed capital schedule, fixed asset schedule, whatever. Bottom line is it works on the same. So I'm going to do property and equipment. So here we look at the opening property and equipment, then capital expenditure. So here, the opening is what was last year. The closing of last year becomes the opening of this year. So I'll just say the opening of this year is the closing of last year and paste it. Okay.
What is the capital expenditure? So I'll go up on the assumptions. On the assumptions, you'll see we had planned what we are going to spend on capital. Then I'll just paste and it is there. Then what is the depreciation? The depreciation, we made an assumption here and said depreciation, look at the assumption in depreciation. The depreciation is a percentage of the property, of the open property and equipment, as you can see. So I'll just take this percentage and multiply by and compute the depreciation. So I'll just take this is equals to, okay, the percentage that I put of depreciation, that is 40%, 40% of the property, of the opening property and equipment. And the opening property and equipment, let's just go where it is this. Okay, so I'll put that. Okay, I don't want to work with the decimals. I'm just going to remove it for now. Okay, so now we have this complete. So I'll just do this. Sorry. So basically,
our closing property and equipment is
the property, opening property and equipment, plus what we bought minus the depreciation. Okay, so that is basically, and you can see the formula was already here below. I'll just bring it. Okay, now I'm just going to capture all of them and extend the formula. Extends it, and it brings everything flawlessly. Okay, now you can see
we finish our property and equipment.
Okay, now we go on our debt and interest schedule. So our debt and interest schedule. So here we go and check. Did we borrow any money, or are we planning to borrow? So you can see in the assumptions we said that we may be borrowing. So I'll go and look for debt. As you can see here, I said, where is debt? I wrote it somewhere here. Debt issued or repaid. Are you seeing there? So I'll pick it and put it there. So that is, sorry. I don't want to mess this. This is, I need to first. So for this is opening debt, and this is issuance or repayment. Okay. So I first need to capture the opening. Okay. So the opening debt is usually the closing. Whatever closed becomes the one opening. So I'll pick the one that is closing and I'll put it there. Then I will say,
I plan either to borrow or not to borrow. So I'll just go and pick from the assumptions. Did I plan to borrow this year? I'll just pick whatever I planned to do. Okay, so you can see I plan to borrow 500K. So I'll just pick the 500K. Okay, so it is already indicated that I plan to borrow. And then, so that means the closing debt is what I had, the Mabanja I had in the beginning plus what I borrowed this year is what I will close in the end of the year. Okay, so the closing debt is the total basically, which I can sum up and say this is equals to this. You can do this plus this, or just do like this the way I'm doing. Either way, it's fine. There's no, okay. And as you can see, the formula was already there. Okay, let me use this time plus so that it is consistent. I'll just pick this and expand this there. Okay.
Interest, as you can see, there was an interest rate we brought up here. What was the interest? Interest, where is it? The assumption of interest. We said interest rate this time is going to be 20%. So I'm going to go down and say, oh, this time interest is 20%. But we calculate interest of the opening debt. So this will be equals to the interest, which is the debt times the opening. Because we cannot predetermine at what point are we getting this money. Is it at the beginning or the end? So it's easier to compute from the debt opening. Okay, so our opening debt is 30 times 20% here. Yep. There you go. The car. So now everything is kawa. I will just extend the car formula. That is usually the sweetest moment when you're extending the car formula. So as you can see, it has computed all the interest rates. Now, this is usually one of the most significant aspects that you need to handle, the schedules, what you plan to do, from the working capital to the fixed assets in terms of buying or selling, and then debt if you plan to borrow or issue. Now, once this is done, my colleagues, I now can go back and fill everything that was not filled. So remember, we have now computed depreciation. I'll just click, okay. Hey, I didn't have depreciation. I just go and say equals to, and I go to the working schedule,
the depreciation schedule. And as you can see, depreciation is here. I just pick it and paste there, okay. So the depreciation is here, and I will expand that. All right.
Now, since I have depreciation, I can now have my EBIT. So I'll just extend the formula here. Now I have EBIT clearly computed. Then we go. What was the interest rate? I just go on my debt schedule
and pick the interest. Where is debt? I go to the debt schedule. There's interest expense down here. I just pick it. Since I have picked it, I can now extend. Okay, I can now extend it. Right. Now I've already picked interest. What else do I need to do? Then I need to calculate earnings before taxes.
Okay. So here I need to calculate earnings before taxes. So I'll just do this. Yeah.
Because there is already an existing formula. So I'll just take the formula because it already exists. I'll just extend it to the others. As you can see,
in some cases we are making losses in the next 2 years, but yeah, that's fine. Corporate tax. Okay, so on tax, it's usually 30%. Okay, it's usually 30%, but ideally, under normal circumstances, you pay the tax when you make the money. If you have not made the money, you don't necessarily pay. But here I'm just going to use the same, sorry, I'll pick the 30%. Remember, it's 30% of the earnings before taxes. It's 30%, and pick it and put it there. Hey, sorry, what happened? Oh, sorry, it's equals to
this
times 30%. 30%, where is the 30%? Tax, yeah, 30%. Sorry, this is a different, so I just need to change this digits. Sorry, sometimes settings are different. Yeah, so I'll do that and extend. Now you realize that that for the years that it is a negative, I'm not supposed to pay because I've made a loss. Okay. Now, I don't want to make this complicated, but anyway. Okay, let me extend the formula, but I'm going to show you also how we can go about it, just for the sanity of everybody. Okay, because ideally I'm not supposed to have tax when I've paid negative. So here I can as well say if, I can add an if statement, but I don't want, I didn't want to bring it up because sometimes it's a bit complicated. If greater than 1 or greater than 0, then, sorry, if this is it, if this expression, if it is greater than 0, if this is greater than 0, then if it's greater than 0, then it can just compute that number. Then it will just return the number. Then return. What do you say? Return. If it's greater than 0, okay. If it's greater than 0, we use a simple one. If this, sorry,
I really wanted a very simple example, but nonetheless, okay. So if the corporate tax, let me first get the formula again. Let me go back and get the formula so that you see that where it is zero, it should not calculate. Okay. So I'll just say, I'll now put in brackets, if this is
less, is it less than zero? Less than zero. Put zero. Yeah. Greater than zero, put zero. Else it can just compute 35 times F12. Okay. So just, yeah. Yeah. Well, you don't have to go through that, but yeah, sorry. Oh, that does not work well. Let me first change this and see. Okay. Okay, for now, because I'm supposed to use a new statement, but for now, I'll assume in some cases we shall pay negative, but we shall just hard code and put where it is negative, we are going to put zero, just so that it does not confuse us and makes us think like it's too complicated. So I'll just do that. This times the corporate tax, 30%, yeah, and finish that. Remove the decimal point, yeah. Extrapolate it, yeah. So for these ones, I'm just going to remove, instead of just input and say, because it is negative, I'll just put zero, okay? So I'll just put zero where it is negative. So that means I'll not be paid. So my gross, my net profit or loss, that will be, I'll just extend the formula below, and so there you go. Your income statement is clear. Any questions on the income statement? Because before I finish to the cash flow, because once we have the working schedule, the rest is just linking. But is it clear? You'll try it yourself, but I hope it will be manageable or chewable. Okay, so here I've basically finished the income statement. I've projected my 5 years of income statement. Okay, you can clap for yourself when you finish there. Then now I can go on the balance sheet. If there's a question, feel free to bring it out. Then I can go on the balance sheet. So remember, I didn't have initially the property and equipment, but we have worked on the working schedule. So I'll just say, okay, now I know my property and equipment. I'll just go to the working schedule. Where's the working schedule of debts and of property? So I will pick the closing property and equipment and put there. All right. So that is my property and equipment and extend. Okay. So I have the property and equipment clearly indicated there. Okay. Then this formula, I'll just extend it. Here. Now I can even compute now the total assets here clearly. Clearly put. Now it's very clear. Okay, now I can go. I'm continuing. I'm still on the balance sheet. I'll calculate total current liabilities and extend. Okay, I'll also extend this. The assumption is it's not there. Yeah. Okay, since all this is generated by formula, I'll change it to color black. It's just a standard. It also makes it a little bit easier to understand. So I'll just change it to black. Change this to black. Change this to black. Change this to black. Okay, we are on the balance sheet, my colleagues, and let's continue. Debt or loan. So the debt or loan, it will be equals to, it will be whatever is on the balance sheet is the debt or loan that I closed with. Remember, there's a closing debt here. Okay, so the debt that I closed with is the debt that I put there. Okay, so the closing debt, and I'll extend because I've already worked on that, on the amount of debt I'll be having. Okay, okay, so that is done. Okay, then we go, so this one can total up, just total that up. Okay, total liabilities. So I can just also extend the formula because we've done it in the past. Once you feed in, yeah, that is it. Then we go to the equity. What is the equity? So equity, remember on our assumptions, we had mentioned that we are either going to issue or repay. When we issue, okay, it increases. When we repay, we subtract. So on our equity, let me just go to equity and say this is equals to, okay, equity capital. I look at the current, if I issued, it will be, sorry, let me repeat that on equity. The equity will be the current, it will be equals to what we have as equity plus what we are going to either give or issue. If you give equity, that means money is coming in. If you pay it back, it means it is. So I'm just going to put whatever is there on the assumption and put it that. So here it will either change. If I add more partners, it will increase. If I reduce, it will reduce. So it will just come there like that. Okay. So there, as you can see, my equity. And then I go on retained earnings. Retained earnings is equals to what I had plus either the profit or loss. So I just go to the profit. Where's my profit? It is there. And I paste and I extend the same formula further. And it will just compute for the other years. Okay. All right. So at this point, we can have now our shareholders' equity, which is just an extension of that summation, and I will extend. And there it goes. And then I can as well just now capture all this. Yeah. So there we are somewhere on the balance sheet, but there's one thing we've not done, and that is the cash. Okay. That is the bank in cash. So this one we shall do. It's the last thing we do once we work on our cash flow statement. So we've worked on the income statement, we've worked on the balance sheet. So we go on the cash flow statement. On the cash flow statement, I'll go and pick. So we start with the net earnings. Net earnings are what you earn your profit or loss. So I'm going to pick my profit or loss here and put there. Okay, and extend. So it will pick the other earnings from the other years. Okay, there we go.
As you can see in cash flow,
everything is linked to the cash flow. So in cash flow, we are just picking numbers from different places. Depreciation and amortization, I will just pick it. I will pick it from, I can pick it from the balance sheet. I can pick it from the schedule or from the income statement, either way. Sorry, we have depreciation here, as you can see. Okay, so I can as well just pick it here and put it there and extend. Okay, it has picked all of them. Then we go change in working capital. Remember, we already computed. I'll just go down and pick it in our working capital schedule. And I'll pick it and paste and put and then extend. Okay. Okay, now that one we've already finished the first part of the cash from operations. And as you can see here, it was saying net earnings plus depreciation less net working capital. So I'll just extend the formula. Yeah, and there you go. Yeah, all right. Then we go to investments. So investments in property, here we look at, did you buy something? Did you buy something? Because if you buy, that means you are spending money, isn't it? So I'll just look at my schedule here. I said I'm going to buy some capital expenditure. There's capital expenditure here. So I'll just put it here. It means I'm going to buy some equipment and I'll just continue with it because I'll be spending money of the organization in buying. Okay, so that is that. What else do I need to do? I need to, did I sell any asset? I'm going to assume in this case, no, not selling any asset. So I'll just put, if I sell, then I can put it up and bring it down here. So I'm just, for our example, just for simplicity, I'll just say we are not really selling, but we have bought some assets. So I'll extend the formula and it will add all of them. Okay, so we finished the second part. Issuance or repayment of debt. So we are now on financing cash flow. So here we have to look at if we get money, if we get debt, that means our money is going to be positive. If we pay, it means it's negative. So I'll just go on our schedule, on our assumptions here. And now we are talking about debt. Here we said we are going to borrow. So when we borrow, it means money is coming in the company. So I'll just pick the debt. Sorry, I didn't put equal sign. So let me just come back and put the equal sign and then go up and pick the debt that I intend to borrow and bring it. Because when I borrow, that means cash will be in the company. So I'll just borrow. Okay, so that has brought whatever I'm going to borrow. And when you're seeing negative, it means I'm going to pay this money. Okay, so it means money will be coming out. Okay, that is it. Then equity, issuance and repayment of equity. So same, if I'm receiving equity, it means it's positive in cash. If I'm paying, it means it's negative. So I just still go back to our assumptions here. Remember, we said, as you can see here maybe we're not giving, but the other years we shall give. So I'll just put here and extend. Okay. For some of you, if you are giving dividends, dividends means money is going out, so you'll have to add dividends still on this financing bit. So I'll just now extend my formula here and add. Okay. Yep. Okay. So that is it. Now, what do I do here? So net increase or decrease. So here I'll just add it adds the three levels: the cash from operations, cash from investing, and cash from financing. And so the formula is already here. So I'll just extend it. Okay. Okay, that's the net. And then here opening, we can say the closing cash balance is the opening for next year. It's the opening, so I'll just bring this is equals to this. Okay. Okay. Now since we have this, closing. So the closing, as you can see, it is a sum of the top one plus the bottom one. So I'll just have that, and then I will extend. I should have extended the whole formula at one go. Sorry, I prefer doing so just for consistency. Sorry. Okay, so I'll do this because I've already generated all. I'll just extend. Okay, so now this basically marks. Let me just do this. Okay, so what I have here is now what I capture and put on the cash in balance sheet. So I'll just pick this and copy, and then go to the balance sheet, which is here, and I will paste it. I'll paste the numbers here, and I will remove the decimal points. Okay. Yeah, so basically this marks the end of linking the three statements: income statement, balance sheet, and cash flow statement. As you can see, it requires a bit of sanity and soberness in the process. Let's just see. As you can see, for the balance sheet, we always say the equation is assets is equals to liabilities plus shareholders' equity. So as you can see, these two have to balance. This one, 66, and this one. And we can pat ourselves on the back if it is balancing. I have just reduced so that we can see at once. So this one and this one should balance. Let me just make them a different color. And as you can see, they balance. Yep. And they balance. Yeah. So that is how you link the three statements. I'll be happy to answer any questions. As you can see, it is like a journey, but they say a journey of 1,000 miles begins with a single step. So those are the steps, and yeah. Questions. So those are the three statements. As I said, the first part, we are just going to link how the three statements work. And we use one tab. I prefer using one tab. As you can see, everything is in one tab, simply because it is simpler. I can now even extend the ratios, by the way. I can extend all this. Can extend this, can extend return on sales, can extend return on investment, can extend return on equity. Then I can extend return on assets. Then I can do liquidity ratios. Let me see. I just extend because the formulas are already there. I don't need to know what is that formula. We just pick the past and extrapolate. because worked that for you. Okay, then I can go to the profitability ratios, pick the gross margin ratios, pick the net profit margin ratios, pick the EBITDA margin ratios, pick the return on assets, pick the return on investment. You know, this is repetition, but yeah, nonetheless, yeah. All right. That is that. I can as well adjust my graphs. I can go and how do they do it? They right click. I think I'm supposed to do some right clicking. Yeah, I can. Let me see. If I change, what do you do? It's not format. It is. Let me just see, because you can extend even this once you're done. Let me see. Let me extend this and say select data, and I select. Where is the data? Yeah, it was picking from this, but now I want to pick more. Where is the data one now? I will say edit and then pick, extend the data. Say okay. Has it picked? I'm not seeing the range. Data range. Let me see. Let me try again. Oh, I may have to do the entire. I may have to just repeat the graph itself. Let me see. Anyway, for the interest of everybody, let me just do the graph. So for the graph, I'll just go and see. Okay, I want a graph that shows my revenue. Okay, so I'll click on revenue and click control. Then I want to compare it with the cost of goods sold. And then maybe I want to compare it with the net profit. Yeah, maybe something like that. Okay. And then I go to insert. And then I can go and see, would I prefer, I'm going to use this time a line graph. Let me just see here. Let me just say I'm gonna use this. Let me just say go on recommended charts and maybe pick this. Yeah, and then I'll generate. So it has given me. Then I can go. As you can see, it's showing 1 to 9 instead of the years. I can now click on the number. Sorry, can click on the number and select data and edit and capture the range. I'll just go to the range and pick this and extrapolate the last one and say okay. Okay, and say okay. So when I say okay, you'll see it has changed to the years. And yeah, so I can wherever I'll put it on the side or wherever I want to put it. Either way, I'll just put here. What have I done? Okay, I can recover. Did I recover it? Sorry, this thing cannot undo. Okay, I can repeat the same process, but I hope you've understood. So it's fairly simple. Yeah. Any questions? Any questions? What do you think? Is it doable? Is it manageable? Yeah. Happy to answer any questions. Happy to answer any questions, if there are any. And then we shall take a 10-minute break. Then we go on valuation and basically close the day. We've already shared with you this template, so it's easy for you to make use of it. Yeah. Let me repeat this process of just for graphs so that maybe it disappeared so that I can repeat. So let me repeat. I'll just pick this. Yeah, and click on control. Then I'll go capture where is the cost of goods sold. I can go and then click on cost of goods sold, pick it. Depending on what you want, then I can pick the net profit and just, yeah, and expand it. Yeah, like that. Okay, so once I do that, I go to insert, go to the charts, I pick what I need, and I say, okay. So it has given me the chart. The only problem is it has not brought the years. So I'll first, let me just put it down. I really need to pull it down, okay? Reaching there, not yet. Okay, yep, there we go. So I've reached the chart. I can expand it and then make the years look like the current ones. Okay, let me take it down again. Okay, then I can, yeah, then I can just pick this. Sorry, I can click on this. Yeah, select data, and then I go and select the data. The data I need to select is for the years, so I'll just pick this, and yeah, then say okay. Then I say okay. Then yeah, it will give me, yeah, with the right years. So there you go, graphical representation, whatever you call it, graphical representation. Okay, questions, please. Any questions, comments? Are we still digesting? Okay. I'm happy to receive any questions. Questions, please. Are we lost? The silence means we are found or lost. Yeah, but generally that is really how you forecast. This is not something we really expect entrepreneur that you must know how to do, but you can get help in terms of getting it. The most important thing is you need to understand what it means. For example, if it has gone, you made a loss in 2022, why did you make a loss? Okay, so those are some of the things that, and then the ratios, the different ratios, your return on investment, because these are things that the investors look at when they say, okay, we can, yeah, we can give you this money or not. Yeah, but generally that is it. Okay, if there are no questions, we can consider this closed, but I'll leave the screen on, but my camera off, so that I can just stretch a bit. And then we are going to do valuation analysis. I hope it is simpler, but it also has its technicalities. Yeah, so yeah, just for you to get some insight on this. Yeah, I'll put us a music tune in the meantime. Thank you. Right. I've stretched a bit. So yeah, let me stop sharing. We can go back now on we can go back on what I needed to inform you. Okay, so where was I? Okay, so as far as what we are covering today, let me just see, because yeah, we're supposed to do some valuation analysis. Yeah, so We've gone through linking the three statements. As I said, it's not something that you must know. But because it was one of the expectations, it's usually a bit scary for some or a bit boring. But yeah, that is how you do it. For those who wanted to know how to do it, you have to start with the, as you could see, the procedure, which I can as well type down here as okay. The procedure is very, okay, not very simple, I'll not say simple. So procedure, when you are projecting one, you have to know your revenue, revenue projections, because that is the key. Once you know your revenue projections, you proceed to your cost of goods sold, sold, okay, those basic, so basically assumptions, you have to work on your assumptions, okay, and that allows you to have the revenue assumptions in terms of growth assumptions, where we have the revenue projections, cost of goods sold, and the other assumptions, Once you do that, then you do work on your income statement. You work on your income statement up to EBITDA, and since you don't have depreciation and amortization, you go to your balance sheet, work on your receivables and payables, and inventory if you do stock. Then you, after that, you can go to the working schedule and work on your debt schedule, work on your net working capital schedule, work on your fixed asset schedule. And once you do that, the rest is just feeling, because and if you know how to feel, it will just naturally balance. As you could see, I was not struggling to, okay, will it balance or not? I was not even asking myself, because in the end, it balanced because they are interlinked. Okay, so the most important thing is just know the process. It comes systematic. That is if you have to know. But as I said, it's not something you have to know. As entrepreneurs, you can just have your financial statements and projections. You can define your growth pattern or your growth assumptions, and based on that, somebody can help you develop something. And from that, you can easily articulate. The most important thing is it has to align with your growth assumptions and your growth strategy. Okay, so that is that on financial statements. As you can see, that expectation was heavy, and I think, but now you've seen, we've now looked at how you can develop your financial statement. That one we've looked at, but as I've said, it's not something you technically have to do. You just need to know your numbers and how they work. And at the bare minimum, just know unit economics, cost unit, whatever per margin, and project, and how what you need to do in terms of your planning. And still, it's something that investors would understand. You've now understood a bit about cash flows, break even, and projections. That one we've worked on. Balance sheets, that one has been covered. Profit, break even, budgets. Yeah, so when you budget, obviously, your cost items are either going to capital expenditure or you are going to borrow. You budgeting, you also budget or plan to borrow if you have to. So all those we've captured and we've put it in the income statement. You've now seen EBITDA, earnings before interest, taxes, depreciation, amortization. We were using CAGR. It's just that I didn't say we are doing CAGR for projections. We were using the past to determine the future. It's one of the simplest ways to project. Okay. Yeah. And somebody said they want to learn modeling. So that is actually modeling. If I change anything, it will be fluid. I don't need to go and start gambling with, okay? If I change anything in blue, it will just change everywhere, okay? And that is a model. A model is supposed to be fluid in nature, okay? And ideally, that's how it's supposed to work. Somebody mentioned about work. I'll probably explain work when I go to valuation, because it's almost the same as your discount rate or your, yeah, it's almost same as discount rate. So I'm just going to explain it a bit, but generally that is it. So we are basically 80% of what you expected. I want to do the 20%, which is valuation analysis. For this, it's just for you to understand a few things that happen behind. In some of these things, you are not supposed to technically like have that you have to know how to do, okay? But this is how you go about it. So I just want to encourage you that it's not something that you have to, okay? But technical people like us, we have to, because we work with a number of entrepreneurs, we have to help them understand their numbers, what they mean, and it also helps them see if they can actually manage whatever financials or debt, if they want to go for debt equity. So we're able to help them through that. That's why on our side, it's something that we have to know. All right, so we are going to go on valuation analysis. I'm just going to share my slide. Let me just see where I put this. Where did I put it? Valuation. Okay, yeah, valuation. All right. Okay, before I continue, hey, sorry, on valuation analysis. Okay, now I'm going to work on valuation analysis, but before I proceed, I just want to do a check-in. Emma, what are your thoughts? Ruth, Emmanuel, Jesse, Mildred, Okello, Susan, what are your thoughts? Where is your mind? Is it digestible? Somebody has typed on the chat. Feel free to talk or type on the chat. Mildred, you need an accountant to coach you more. Well, if you want to know, but you just need to understand what it means, you don't necessarily have to know. And then it is not for accountants, it's actually financial analysts, because accountants work more on the day-to-day. Corporate finance is not usual. It depends really on which kind of accountant. Yeah, so you'll realize that not all accountants can do corporate finance. Yeah. Okay, Susan. Akeni, what are your thoughts? Emmanuel, what are your thoughts? Jesse, what are your thoughts? Rona, what are your thoughts? Okay, yeah, but I've shared the assumption. By the basic assumption is at least you know how to pull formulas in Excel. Just extending where you click on that corner and just drag. Dragging formulas you can. If you can at least know some of those basics, then it will be easier. Yeah, but you wanted the math. Ruth is saying that there's a lot of math, but that's what you requested. I asked you for your expectations and you said you want to know, okay? And that is what it takes to know, okay? So it's a bit, as I said, complicated, but you don't have to know how to do, okay? But I've shown you what it takes. The most important thing is for you to understand the numbers, the margins. Oh, I make 25% margin. We expect to grow by this percentage. You know, those are the insights. We don't expect you, oh, now this is how the balance sheet has to. Nobody wants, you are not going to tell an investor that you know how to do the balance sheet. It's not a plus. It does not add anything, okay? But if you know what your balance sheet means, or your income statement or your cash flow statement, that is enough. That is really the important bit. Okay, so I don't want to make you see or feel worried, okay? But for those who, financial analysts, corporate finance especially, that is important because we have to know how to help somebody determine which is the best project to proceed with, their cash flows, how much money they can borrow, etc. So those are important to our side. Okay. But as I've said, since it was an expectation that you wanted to know, I hope that was worthwhile. All right, let's look at valuation. So there are primary valuation approaches, and
one is the market approach, the cost approach, and the income approach.
Market approach, cost approach, and income approach.
For cost approach, I'm just going to explain how it works. And it applies more on real estate, and you'll notice most banks tend to use cost approach. And that is why rarely do banks support ICT guys, e-commerce guys, maybe in shop or retail, they do trade, they do. But it's because of the methodology that they use to value. They use the cost approach. In cost approach, what we are saying is we look at the replacement cost of an asset. So for example, if I had a house, what is the market value of the house? Okay. And you'll notice that's what banks do. They just come and say, okay, what assets do they have? They have land, he has buildings, he has stock, it is worth this amount. So to them, the value, the market value of that is the value of the business. For them, they don't consider the value that you've created from market and goodwill. Okay? Or you are, okay, they may look at the cash flow, but the cash flow is for them just to determine that you can pay. So most of them look at basically the asset, the tangible things that they can see. And that is why, for example, in Ham's case, it was basically buildings, the land strategically located, and said, oh, we can give you $7 million. Okay, so in most cases, the cost approach applies best in things to do with the real estate. Okay, things like real estate, land, housing. Usually you look at the replacement cost of an asset, or you can say the market value. So we look at whatever asset is there, whether it's a vehicle, whatever we look at. If I wanted to replace it, what would be the cost? Okay, and that is basically the cost approach. It's as simple as that. So depending on the business that you do, we can just come and say, okay, if it's a shop with stock, I just look, okay, the shop, if it is the building is yours or whatever, we look at the value, the entire value, and say, okay, based on the cost approach, this is the value of the business. So it is not fair for businesses that have a lot of goodwill, that do things that are not seen. For example, Safe Border, it's just a software. Jumia is just e-commerce. It's not something that you can see or touch. Zoom is valued more valuable than even 6 airline companies, but you cannot touch Zoom. Okay, so cost approach cannot apply on that. But as you can see, cost approach simply allows you to look at the asset. Okay, all right. If there's any question on cost approach, I'm happy to answer. Then market approach. Market approach, we look at the data in the market. So we go and look at stock. For example, if any of you is in health, I go and look at a similar company in health in the most thriving markets. So in Africa, the most thriving market is Nairobi Stock Exchange and Johannesburg Stock Exchange. And usually there is data. So no worries, there are various sites where we get this data. So we look at a similar company and look at their ratios, then look at your performance and multiply by the market ratio of that sector. So that is the market approach. But because technical people don't want to minimize complexity to the entrepreneur, on standard, unless you are doing software or things to do with like e-commerce,
in standard terms, when we look at your EBITDA, you've just done profit and loss. When we look at your EBITDA, if your company is profitable, is in its profitability, and we look at your EBITDA, okay, the value of your EBITDA multiplied by 5 will be the assumed value of your business. So let me just do that again. So for example, your EBITDA currently, some of you say, when I ask you your turnover, usually we are trying to see to what level of your EBITDA ratio will be. So maybe your EBITDA is 10 million. 10 million. Okay? Your EBITDA, okay? That is earnings before interest, taxes, depreciation, amortization. I will generally, in standard accepted terms, my EBITDA times 5 can be a fair assessment of the value of my business. Okay? So that EBITDA, so if you do your income statement and have your EBITDA, when you multiply it by 5, that is a fair determination of the value of your business using market approach. But it can be more accurate if you use the market data. But if you are in software, this will be an unfair assessment. We may have to multiply. For software, especially things like Zoom, we may multiply it by 30 because their ratios are higher. People of software as a service, platform as a service, their ratios are usually very high, and that's why they are highly valued. So like Zoom, Amazon, you may find the value is really, really high. For e-commerce, it's a bit different. We look at the value varies, but because many e-commerce companies, some of them are not making profits, like Jumia. Jumia has not been making profit. I don't know if this year they have made profit. But for us, for an investor to determine if they can invest in it, they just look at the lifetime value of the client, the people who buy from Jumia, divided by their customer acquisition cost. If this ratio is above 5, then it's worth investing in that company. If it is greater than 5, that's how e-commerce guys sort of communicate that they are doing well when it comes to marketing their product, their company to investors. Okay, so I was just trying to make it easy. For market approach, you just generally, we can just take your EBITDA and multiply by 5. However, if it's software and you are generating money, my dear, the value is usually very high, especially if we can see the market potential and the adoption. A few assumptions are added. Okay, so yeah, that is as you can see what comes out with market approach. Now I am going to use I'm now going to go to the third approach, and that is the income approach, which is usually a bit technical. And I'm going to use an Excel sheet that I shared with you guys. It's a bit technical, but since some of you wanted to know the different valuations, I'm also going to show you how to do the income approach. And in the income approach, we use, some people call it income approach, but in corporate finance, that is discount cash flow, DCF model, call it discount cash flow analysis to determine value of a company. So how do we go about it? I'm going to show you. Does anybody have a question on the cost and market approach? If there's a question, feel free to ask me. I presume by now you have an idea, the value, if you're looking at market and cost approach. Okay. If there's any question, feel free to ask or type. So I'm going to look at the income approach. And as I said, it's a bit technical. But as long as we put the formulas, you can put the numbers. Okay, so I'm just going to put the formulas. You see how we put the formulas, but you don't need to know the formula. if you have the numbers, you can just be able to replace your numbers and see the value using income approach. So let me do that. So I'm going to open the Excel. There's an Excel I shared, income approach. It's called income approach. The Excel is called income approach. Where is it? Yeah, it's called income approach valuation begin. Income approach valuation begin. So I'm going to open it. Okay, all right. I'm going to begin it from scratch. Let me just see if I can, yeah. Let me see, let me open it. So this is how the Excel looks like. Hey, you mean it is complete? Let me delete. I've opened the wrong one, sorry. Let me open the right one, don't save. Let me open the right one. Okay, let me just open it again, the right one. Okay, let me open it, let me share. Okay, all right, so let's look at this. How do we value using the income approach? So I'm just going to delete this so that you see how about it. Let me just delete, 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 yeah, and delete. Okay, so let me start. Okay, first of all, we have to determine the free cash flows of the company or the business. How do we determine the free cash flows? Free cash flow is cash that is available in the company. Sorry? Okay, so free cash flow is the company the money that is available in the company. So if you have a balance sheet, the cash balance of the current year. So I'm going to assume we are in 2018. So the cash balance is 5K, okay, $5,000. But I need to determine for the other years. So if I have already gone through forecasting the way we did in the first part of the session, I'm going to determine the free cash flows. I have to get this cash. Are you seeing this? Cash from operations. Okay, so let me first delete this. I was just showing you. I'm going to pick this cash because it is cash that, the cash available from operations. So I'll just pick that 30K. Okay, and then subtract it from the amount of money I expect to invest in capital expenses. So in the assumptions here, let me go to the assumptions. If I go on the assumptions, you'll see that he expects to spend 6,176 on capital expenditure. So I will just pick. So that means my free cash flow will be 24. So I will just extend this. Okay, I can make this in USD. You can just get the USD sign. Can just get the USD sign. Yeah, and reduce this. All right. So I have got the free cash flows. Basically, it's the cash available after I have spent on the capital assets. Hold on, let me just work on the background noise. All right, sorry. Okay, that's fine. We can proceed. So I've got the free cash flows, and I repeat, the free cash flows, it's the cash This is the cash balance if it is your current year. And for if you are projecting, you'll just pick the cash from operations minus the capital expenses. And I have just done that for all the years. So that's one of the things you need to have. Okay. So that is the first thing that we need to have. I will pause at that and explain a few more things. Now, once you know the free cash flows, the next thing you need to know, is your present value. Now, in corporate finance, there's something we assume. Money now is better than money in the future. We always say money now is better than money in the future. If you give me 100,000 now, it could be worth 150,000 later. But now it is 100. Could be 150,000 later. But as of now, it should be more valuable. Okay, I'm trying to find the best way to explain. If somebody was to give me money now vis-a-vis a year later, okay, and said, if I was to give you 10,000, how much should I give you if I was to give you this money after a year? It probably will be 15,000 after a year. But now it's 10. In other words, the more time increases, okay, money in the future is not as important as money now. Like the time value of money is very important, and the income approach assumes that you can put or give us projection and say in the future we shall make $1 billion. So the income approach tries to evaluate how much is that $1 billion now. Okay, so that is the concept of time value of money. What is the value? So when you go to a bank and say, I'm borrowing 1 million shillings, they will say you are going to pay back 15 million shillings. Are we together? So that, according to them, that is the value. Okay, so that is a concept that income approach makes use of. Okay, so I wanted just for us to understand that concept. Then I show you how we go about it. So once we determine the value in the future, because in your income approach, you've calculated, oh, we shall make EBITDA of 30 million, 50 million, 100 million. Now we need to translate these figures now. Okay, now how do we do it? We have to determine what we call the present value of those numbers. As I've said, my caution is you don't need to cram the formula. The formula is fixed. We can, the most important thing is just know the concept. So let me share my screen and I'm going to calculate the present value of these numbers. Okay, so the present value, as you can see, I've put here, present value of the free cash flows. So currently 5,000 is 5,000, and I can show you evidence that 5,000 is 5,000 by saying this is equals to, Excel has this formula, present value. Present value is equals to the rate, discount rate. Now I will explain the discount rate a little bit more. The discount rate is equivalent to your cost of capital. Okay, your cost of capital is different from interest rate. You see, I may get money in form of debt, and I may also get money in form of equity. Okay, now if I combine the returns I need to pay, it will give me what I would call like the discount rate, or ideally the cost of money. It's like, what is that cost that a lender or the average lender, whether it's debt or equity, would give me money. And that's why when Bertha asked, what is work? Work is the weighted, like I can weigh I got some money at 20%, I got some money at 6%, I got some money at 30%. When I weigh the overall rate, that becomes the discount rate. Okay, so present value, asked for us to determine the present value, I'm going to repeat, we have to translate this cash into the current value, the current present value. So I have to look at present value, and the formula is there. I have to put the discount rate. So I have to put rate. Okay, I've put the rate. Then the next thing I have to put is the period. How far ahead am I discounting this money? Is it a year? Is it 2 years? Is it 0? So in this particular case, you will find I'm on the current year. The current year is 2018 for this particular case. So I'll do the current year, which is, I'll do this. Okay, are you seeing? The year minus 2018, because I'm putting the current year. And then I'll put what payment. So if any of you expect to pay like a dividend, then you can put you can put that you can put the amount, but I'm going to assume that I'm not going to pay a dividend because I'm a startup. I'll just keep on reinvesting. So I'm going to put payment at 0. And then I'm going to look at the future value. So the future value is this, but remember, this value is an outflow. It's like it's ahead. So I have to put a negative because it is ahead. I don't have it now. So I'll put the future value and put the figure I have now, but in the future. And then I have to choose either 0 or 1. Is it at the beginning of the period or the end of the period? So I'm going to put it's at the end of the period, and that is 0. Then brackets or parentheses. When I do that, it will give me, when I do that, it will give me that. Then I can extrapolate. I can just extend the formula. And when I extend the formula, as you can see, it has brought the same digits. Why? The reason is I've not put the discount rate. Okay, I didn't put the rate, but now I'm going to assume that my rate is okay. In US dollars, if somebody gives you money in US dollars, our current rate is about 11%. So I'm going to say the discount rate is 11%. So I'll put 11% and just extend this through and through. So since I've put it's 11%, sorry, 11%, as you can see, it has discounted that money. So 24,000. Now, at this point, $24,000 is equivalent to $21,000. $28,000 now is currently equivalent to $22,000. $31,000 currently is $23,000, and $34,000 is equivalent to $22,000 now. $39,000 is equivalent to $23,000 now. So we have discounted this money into what is the current value of that money. If you say you'll make $1 billion, what is the value of $1 billion now? That is the present value of the free cash flow. Okay, so once we do that, we've made a step. Now, one thing we now need also to compute is what we call a terminal value. Now, what is a terminal value? Now, the assumption is, and by the income approach makes a lot of assumptions. Now, the assumption is your business will be growing very fast, and then it reaches a point where it will not. It will grow maybe marginally or not as fast as it used to grow in the beginning because you are not as aggressive or you've now secured the market that you wanted, etc. So the assumption is you'll reach a point of residual value where you've reached, it's like a vehicle, when it reaches the depreciation value, you can only salvage a value as per that. That's why you can see MTN saying, oh, we are selling vehicles. You are saying we are selling vehicles, because according to their books, it has reached that point where they have already get its entire value. So the terminal value in our case is after these years where our business plan runs. After these years, the business will grow at what percentage? Remember, when we were doing our financial statements, we were making assumptions on our growth, on our revenue growth. So I'm going to assume that in the final year, or the year 2024 and beyond, okay, it will just increase by a lower percentage, because now it will not be growing as fast as the years where I was putting a lot of energy to access the market. Now it's stable. Now it will not be growing as fast. So I'll put maybe 5%. I can as well put, well, 6%. Okay. So that means beyond it will grow on a lower, let me just put 4 maybe. Okay. It will grow on a lower pace. Okay, so that is the assumption. Now, once we do that, we can calculate the terminal value. So what is the value of the business at that point of terminal value? So this will be equals to this previous year multiplied by 1 plus this percentage. Okay, divided by the discount rate, which is 11, minus, sorry, I have to put this in brackets, minus discount rate, divided by discount rate, minus that value at that time. Okay, so that is 7. So when I do that, it will give me now the value as at this year and beyond, okay, at 2024. So what I need to do to now have the value, the terminal value as at present, I will just extend the formula again, and I think I had not, so let me extend. Okay, now you will see it's giving me a hashtag value, because here we have put 224 and beyond, so this is not a number. This is not a number. So when I look at the formula here, I need to make it a number so that it computes. So I'm just going to delete this and say it is 6 years later, after in year 6. So I'll just put that, and now it will give me the number. Okay. Now, since I have all this up to year 6, all I need to do is the value of the farm. Okay. The value of the business will be this. Okay, I'll just do sum. I'll just sum all these figures in present value. In present value. And once I do all these values in present value, that will be the value of the farm. So the farm will be valued at 429,636. So that will be the value of the farm using the income approach. As I said, it's a bit technical because there are variables. You have to determine your free cash flows. Okay, this is cash that you will have after buying whatever equipment, whatever you're buying. Then we have to convert this cash in its present form, because whatever you say you'll gain in the future is not now. So we have to convert this money in its current state. That's why we say present value. And the formula is put, so you don't need to worry about how do I compute. You can just replace, once you have this, it will compute for you. All you need to put is the discount rate, and as I said, the discount rate is equivalent to the rate that you are given as a business. Each business, depending on the money that you borrow. Sometimes you borrow for free from yourself. Sometimes you borrow from the bank. Sometimes you borrow from external entities, and depending on what is the average rate at which, so we shall use that to determine the discount rate. Ideally, that is the case. So if you've never borrowed and probably intend to borrow from the bank or whatever, so you can just still use 20%. But if you are calculating in US dollars, 22% is like 11% because dollars are of a higher rate. So the percentage is usually lower. As you can see, it's a bit technical, but yeah, that's how we go about it. Questions? Questions. This marks basically the end of financial modeling and analysis. Any questions, please? Can I do a check-in? How has it been? You asked to know very complicated things. Now, I couldn't say no. Sometimes you need to indulge yourself so that you can, okay, this is how people go about it. Yeah. So can I hear from you? Mildred, Emma, Ruth, Rona, George, Jesse, Susan? What are your thoughts? Ladies and gentlemen, Mildred, which documents do you need? Investors usually ask, I'll talk about it tomorrow. Okay, I hope but generally, let me just see if I have that slide. They are basically general. Okay, you see, there are documents which we share with investors, and usually you share your business plan, financials, and pitch deck. Either of them. Usually financials are separate, but pitch deck or business plan, you may find you do either or both. Then we obviously have to look at the past, depending on the finance you're looking at. If you are looking for debt, there's less scrutiny. A lot of scrutiny will be evaluated based on the business capacity to actually pay back. But if you're going for equity, it's almost like going to get a marriage partner. A lot of scrutiny comes in because we have to evaluate how you keep books, who are the team, whatever. Sometimes you don't have everything perfect, but we expect you to move into a path of perfection. So, but most important thing, keep your books, keep your records, whether you are keeping in a counter book. Try and be using the bank if you are using the bank to transact, or have a mobile number for the organization that you do not transact, so that it's you and the business and you, where we cannot differentiate. Okay, so have a mobile, if you do mobile money, which is so that you can as well go to MTN if you need a financial statement, they can print. That will allow you can as well reconcile. We are in a post-COVID era where sometimes you may not be using the bank or whatever, you may be using mobile, whatever. So there are ways in which you can go about it. Usually ID, and the business should have a location. We need to know how it is performing. We should be able to track back. We need to know who you are in terms of the business, where you see it. You see, it's not the business they're investing in the person who is managing the business to take the business to the next level. So this person behind the business is a very important element in that journey. Yeah, the recordings are going to be shared. I'm sorry we delayed to share yesterday, but I'm certainly going to ensure that we share all this today. Tomorrow it's going to be very light. It's going to be very fun because we are going to now see how we can articulate, and we shall all practice a bit on how we can convey the message. But since the expectations were to know, you wanted to know how to do financial modeling, that is how a model looks like. A model is a fluid document that you can take to a financial, say, I don't think you'll grow at 20. Or you can say you will grow at 20, then you grow by 10. You can change 10 and it changes everything, okay? But as you can see, the process of making it that way is what sometimes affects people. So it allows fluidity, it allows flow, okay? The other alternative is we also shared a sheet where you can simply project by putting hard digits. Nonetheless, either way, it's fine, but financial models are sweet, it's like the swagger bit. But we're also going to share a sheet where you can as well type, this year will make 3,000. You type 3,000, 4,000 etc. And you just make it's okay. Nothing to lose. At the end of the day, you will still have a financial plan, and that is really the most important. But if you have a model, you know, it's sweeter, it allows a conversation. It's something that you can actually use as a working document, depending on the performances, and you will actually see the different factors, okay? Oh, my operational costs have reduced, my variable costs, you get. So it can allow you to even see how your business is performing at any given time. That's the beauty of a model, but you don't have to, it's not a must. Nobody will judge you negatively by not having a model. Just have a plan and clear information of how that goes about or the result of it. So you have all. So yeah, just to emphasize what I meant, because some may be wondering, okay, what have you just shared? Let me just show you I'm not going to talk much about it, but we've also going to share with you this initial financial template. So the alternative to you computing and whatever, and you don't have to go through the journey of a financial model, you can just use this, which we're also going to share with you. So there you just put your details and you put, yeah, you had the code 45,000, units sold 23, it computes for you. Just for the rest of the years, it will still give you it will allow you to have your projections, okay? And yeah, it's still fine. It's still something that can be used. So at the end of the day, no worries. The most important thing is you can articulate your numbers. And tomorrow we are really going to delve into how can you articulate your numbers in a way that people appreciate your knowledge of your business. Okay, so I hope this is consolation for those ones who say that the model is sweeter, but my dear, it is. But once you have the finished product, it's so nice to have because it allows you to see, okay, so my return on investment, it's sweeter, but there are trade-offs. There's always a consequence to either way. Ours is to expose you, and it's up to you to see what works for you. All right. Today really marks probably the most difficult of the training sessions, both for you and to me, because usually I have to think, really, do I have to go about this? Do I have to, because you don't want to make it discouraging, because I don't know the level at which we are, but at the same time, since we wanted to at least know how to go about it, yeah, we had to try and do this. Yes, we are going to share all this. And by then I'm stopping to record because basically finished the